Okay, welcome back, and here we are in the fourth session of the Introduction to Property Investing, and what we're going to look at now is some tips on how you pull everything together and how you create a strategy and get the right information. So we've looked at assessing the market, looking at the pyramid, looking at where to go, how to invest, where to source properties, and then a session on capital and how to spot whether the market's going up in value. Now we're going to look at creating strategies and dealing with pieces of information within it. So session 4 is about strategy. Now, we already know that we have a principle of a shape of a pyramid. There's lots of reasons for that. As I've already said, it's the structure that stood the test of time. It's one that's resilient. It's self-supporting. You have this big solid foundation level at the bottom which supports the stuff going up, and it incorporates risk and reward, and it becomes self-perpetuating, and you can use one pyramid to provide the cash for another, or even a deal within the pyramid that provides the cash for another deal within it, as we did with the previous example. Now, it's a perfect structure, and that's for many reasons, and I do just want to talk about my hobby horse at the moment, which is the golden ratio, which is the Fibonacci sequence of numbers. Now, I don't know if you know anything about Fibonacci, but he was an interesting, not necessarily a mathematician, but he worked out that there was a standard measure, what's called the golden mean or the golden ratio, to how things are put together. So, for example, with a human being, the ratio between here and here equates to 1. The ratio from here to here equates to 1.61. The ratio of here to here is 1. The ratio from here to the floor is 1.61. Even your teeth, your big teeth in the middle, are 1.61 bigger than the teeth on either side. And the closer that you get to that ratio as a human being, the more perfect you are as a specimen. So lots of the lovely looking luscious people we see on the telly and in magazines, their internal ratio is closer to 1.61 than the ugly people that we don't see in magazines and on the telly, because their ratio isn't very close. So apparently one of the perfect or the closest to the perfect ratio is Emma Watson, who was Hermione in the Harry Potter. If you look at, there's actually been an analysis done of her face, and everything is in the 1 to 1.61 ratio. Anyway, I digress. With Fibonacci, he actually discovered this ratio and this concept, and he also discovered that it was prevalent throughout nature. So if rabbits populate at 1 to 1.61, if you take a tree, the leaves expand at the rate of 1 to 1.61, and so on. And when it was discovered, they thought they'd actually discovered God's blueprint for creating the earth, because it was the ratio that was prevalent throughout nature. It's throughout the human being, and blow me down, it's throughout history in terms of our architecture. So a pyramid is a standard Fibonacci ratio created event, and so are all of the other major pieces of architecture throughout the world, from the Parthenon to Notre Dame to so on, and they all have used or were aware of this magic sequence. Now, I mention all of that because this sequence, this ratio, this structure is throughout your life whether you like it or not. So, for example, a credit card is also created on the structure of 1 to 1.61. The Apple logo that you all know and love and you see every day, the bite out of the apple is a Fibonacci bite. So you are actually being presented with this structure day in, day out throughout your financial life and various other parts of your life, whether you know it or not. It is also one of the prevalent structures throughout financial investing. So it's also used as a ratio, as a driver to predict wibble wobble jelly on the plate, for example. So it's very common to get share trading strategies that trade off what's called the Fibonacci wave, because it's a way of predicting the way that the market will move. So actually it's much more common than you think. Now, I won't go into how it's used specifically within the property market, other than to say the reason that we've chosen the pyramid for the structure on which to build your portfolio is purely because of all these inherent things that are built within it, and just accept that they're there. And if you want to read more about Fibonacci and how it all works, then please do. And I'd love to talk to you over coffee at some stage, because it's one of my hobbies. Now, so when we look at the pyramid, the Fibonacci ratio, the Fibonacci development, is about always adding up the two numbers that you've got to start with. So you start with 0, then you take 1, you add 0 and 1 and you get 1. You add 1 to 1 and you get 2, and you add 2 to 1 and you get 3, and so on, and you add them out. So it won't come to any surprise to you that the ideal portfolio that we create has got 1 at the top, followed by 2, followed by 3, which is the sum of these two, followed by 5, which is the sum of these two, and then followed by 8, which is the sum of these two, because the standard pyramid is built on a Fibonacci sequence, and that creates a portfolio of 19 properties. With 19 properties, you are safer. It's self-supporting, self-sufficient, self-funding, and you're off and running. Now, even if you don't mind or don't care at all about Fibonacci, just let that bit go if it's of no interest to you. It's of interest to me. I like the academic and theoretical background. Even if you just pick up one thing, it's this number here, 19. When you have 19 properties, one will always bail out another. If you've got 19 properties and one gets into difficulty, the other 18 will bail them out. So you've got resilience and strength when you've got 19. If you've only got 2, 3 or 5 properties, you are more at risk than if you've got 19. And 19 is about the optimal number. 20 is clearly better than 19, but it's a marginal thing at that stage. Once you've got 19, you're solid and reliable. Now, when you're building your portfolios, you don't have to do them exactly like this. This is a proposed ideal structure. If you want to start with Buff and Fluffs, or even if you want to start with HMOs, that's perfectly okay. You don't have to start at the bottom left and work your way all the way up. And you find that the more experienced you become, the less standard your pyramids look, the less standard your portfolios are, because you develop a technique or a niche or a USP for doing certain types of properties. I'm an income girl, so my pyramids always look like voluptuous ladies. I have very broad bits around the income and very narrow on the capital, because that's my style. Another speaker, another expert in the field may have a completely different approach and be more capital driven, but it's perfectly okay. Start with the basic and then start adapting it to your style. So you don't have to start at the bottom. You can jump around, as long as you don't jump in at the top. As long as you jump in down here somewhere, you're relatively safe. Now, the order in which you could do it, and which is the safest, is obviously to go from the bottom up is the safest, but it is also the slowest. If you already have a little bit of experience as a property investor, you might decide that the bottom tier isn't for you at all. Now, perfectly okay, it's your gig, it's your investment life, you can do exactly what you like. But if you don't have any properties at all, starting with a bit of safe, secure income won't test you too much and shouldn't get you into too much difficulty. Now, the inexperienced investor, although they might want to jump straight in at the HMO level and above, they might struggle to raise the finance, because with a lot of finance providers, they only want to lend money on what they perceive to be higher risk properties to people who have experience. So if you don't have any experience, you're going to find it a lot easier to raise the finance from the bottom tier up. If you want to go for HMO type of properties and you want to get funding, fund providers will normally look for a few years experience and a certain number of properties. They want to see some evidence of experience. Now, as I've said before, go income first than capital, because if you've got income coming in, you're positive. If you've gone straight for capital, you're immediately into the position of paying out rather than collecting in, because you're paying out to buy the property, you're paying out to refurb it, you're paying up to put in a new bathroom and so on. And while that's happening, you're not collecting rents. So it's a payout. If you do capital, it's a payout. If you do income, it's collect. So you're always better to start with income. Go low, then high risk, and then small, then large. And we've covered all of that already before. Now, what to look for, shall I jump back to there just so that you can get it all down? The order that you create your strategy in. Of course, once you've cut your teeth and you've done a couple of little ones, well then by all means buoying up a higher level and off you go. But you can see that the pyramid gives you jam now, jam in the future, and combinations of everything as you like. Now, when you're looking for a deal, demand is always the number one factor. Please don't buy where there is no demand. You would be an idiot and I would come and get you at night. I mean, please don't do that. So the way that we evaluate properties are in this order. First of all, always check for demand. If the property is going to be one that you want to have in an income tier of your pyramid, this is how you evaluate it in this order. So evaluation for income looks like this. Number one, is there enough demand? Find the demand, get the person's phone number. Then check the property, find a property, does it wash its face? Now we did wash its face in a previous session, one very broad brush, one with estimates in and one with detail in. So go down that 3 tiers of wash its face until you find the one that works. The next thing is to then check the return on your cash invested, which is also your cost of capital, as we know. And you can do that exactly to 100% because you can do the wash its face to exactly 100%. So you can then calculate the return on your cash invested exactly and the cost of your capital exactly. So when you're assessing the income, demand, wash its face 1, 2, 3, getting more detailed each time, calculate the return on your cash, calculate the cost of capital and do it exactly to 100%. Then, as a contingency, run it down upwards. So even if it's a property that you're going to let out, and that's the only intention ever to do it, it's still worth checking it against upwards. Because if a property doesn't get any ticks on upwards, I'd think again about that one. Okay, because you always want the potential for some jam later. You see that I've got there contingency and a second exit. For every property that you buy, always think about having an alternative out, just in case the market changes and you can't get out of the deal in the way that you'd intended. So if your intention is to buy a property to do it up and sell it, if the market turns you might not be able to sell it, so you have to have the contingency of putting a tenant in there. Okay. Likewise for income, if you can't get a tenant in there because of some reason or another, something has changed, you've got to have the contingency of being able to sell it instead. So always make sure you have that and check against upwards. Then check the affordability of can you afford it, or rather should I say how do you afford it. There's no such thing as can you afford a property, because if you can find the right deal, somebody will find you the right money. And in most cases, if you can find the right deal, I'll lend you the money. I mean, it's easy once you found the right deal. So affordability comes then. Now, to look at the capital side, so this is how you assess for income. You do them in this order. For capital, you do the same things but in a different order. Number one, if you've got a property that you think is going to be a buff and fluff or a capital project, number one, you check for demand. Always demand is number one. Number two, you check it against upwards. And number three, you check the return on your cash invested. Now, it's different with a capital project, the return on capital invested. It's different to the income calculation. So I'll show you an example of how to check your return on cash invested on a capital project. First of all, you take the ultimate sales value. What are you going to be able to sell this thing for once you've done it up? Then you deduct from that your cost of buying it, your purchase cost, and the cost of doing it up. Now, the sales price less the purchase cost less the cost of doing it up equals your profit. Multiply the profit times 100 to get yourself a percentage and you have the answer. Now we'll go through one. So when you're evaluating for capital, demand always number one, then check upwards, then check return on your cash invested, and this is how you calculate the number. and here is a number to go through using the one that we've already looked at. Now the ultimate sales price of this as a house was 600,000. The purchase cost was approximately 380,000, and the cost of turning it from an 11-bedroom care home into a nice 5-bedroomed posh house, detached family house to live in would be about 75,000, for example, which means my profit is 145,000. So that's a good enough indicator as it stands. But then we want to work out the percentage, the return on my cash. So 145, which is the profit, expressed as a percentage of my costs, which are the 380 and the 75, multiplied by 100 to get a percentage, and it comes out to 31.86%. Okay, which is pretty neat, pretty decent. A 31% return on my capital would be pretty decent for a capital investment. Now, evaluating for capital then, so we've checked demand, we've checked upwards, we've checked the return on our cash invested, it's different from income to capital. We then still check wash its face. Would it stack? Would I be able to get a tenant in there? Because if I can't sell it, I might have to hold on to it for a while, and I want a contingency and I want a second exit. And then finally, we check the how do we afford it. We never look at the affordability first. Never. Okay, we check all of these other things first. So every deal you go into, whether it be income or capital, you need always to check that it would work the other way round should you get stuck. Always make sure you have a second exit, and then check affordability. Now, set yourself targets. Now, appropriate targets for you depends on you and your circumstances, but for instance, your return on cash invested on an income type of project, a very healthy return would be 10%. You can get basically 0.5% in the bank. Down here, the average rate on bank deposit accounts is 0.44% per year, so 10% would be a pretty healthy return on your cash. With return on capital, a pretty decent return would be 30, a perfectly reasonable return would be 20, so somewhere of that range. And think about the cost to you. Often with capital projects, what people are aiming for is enough money to give up work. So they earn 20,000 a year. If they can do a project which gives them 20,000, they think to themselves, all I've got to do is one a year and I've replaced my job. So sometimes for people, certainly when they first get started, it's more of an amount than a percentage. But you'll get used to working that out. So set yourself a target and then look for deals that meet the target, both on the income side and on the capital side, and think about the cost to you. Consider your job and what you earn and how you're going to replace it, what savings you've got, what personal expenses, what risks you carry, whether you've got 17 children all needing to be fed or whether you're a single person makes a big difference, because you can take more risk when you're a single person. If you've got babies to feed and look after, then you can't take such a bigger risk, and so on and so on. And the time that you have available to do it. Now, affordability, we always look at this last. Now, this is something that always drives people nuts, because when they start investing, they come up to me and they say, I've only got £10,000, what can I buy? And I say, I've got absolutely no idea. I mean, because I never ever look at the money until the last thing. Now, I don't do that for several reasons. First of all, when the pyramid is clear and you've looked at the deal, so for example, with the deal where the house where we could have made 50% on it, if you'd have started off saying we need to put in 95,000 to buy that property, you would have all said, oh no, I can't afford it, can't do that. When you look at it when it's done and you see that it generates 50% return on your money, you then start thinking, well actually, probably I could work out how to make that happen. So you look at it with a different perspective when you know what the return is going to be. So that's first and foremost. When the pyramid is clear, when the returns are clear, you get certain and happy and more relaxed and more confident about borrowing money. Secondly, when the pyramid is clear, You can borrow from other people, okay? You can borrow from your Auntie Flo, you can borrow from me, you can borrow from different people, and we show you how